Welcome back to the channel, everyone. This is your James G, where we cut through the noise and look at gold and silver through the lens of physical reality versus paper promises. No hype, no guarantees, just disciplined analysis of what's actually happening in the metals markets. Before we dive in today, let's get the important stuff out of the way right up front. Scam and impersonation warning. There are people out there pretending to be me or this channel, reaching out in DMs, comments, emails, or anywhere else, promising signals, private groups, managed accounts, or special opportunities. None of that is real. I do not have a paid group. I do not offer signals. I do not manage anyone's money. I never ask for payments, crypto sends, gift cards, or anything of the sort. If anyone contacts you claiming to be me or affiliated with this channel and ask for money or personal details, block them immediately and report them. Protect yourselves first. Always verify through the official channels only. This channel is free, independent, and stays that way. No investment offers here, no solicitation, no pitching products or services. We're just breaking down data and system stress so you can make better informed decisions on your own. With that said, shout out to the longtime community. If you're an OG who's been here through the ups, downs, dislocations, and everything in between, drop OG in the comments right now. And wherever you're watching from London, New York, Shanghai, Dubai, Sydney, drop your city or country in the comments. It's always eye-opening to see where the real physical interest is coming from around the world. Let's build that map in the comments section. Today we're looking at a market that's been extremely volatile in recent weeks. Gold, hovering around the $4,900 to $4,950 per ounce level after sharp moves. Silver showing even wilder swings, recently trading in the mid-70s after dramatic ups and downs. We've seen historic sell-offs followed by attempted recoveries, with massive physical demand signals clashing against paper market liquidations. The divergence between what's happening in physical bars and coins versus futures open interest and ETF flows is widening again. And that's exactly the kind of stress we're here to dissect. Without exaggeration, stick with me as we go through the data step by step. Remember, this is not trading advice, not a prediction, and definitely not a call to buy or sell anything. Precious metals here are framed as strategic assets for long-term wealth protection and national security inputs, not short-term gambling vehicles. Always verify every number yourself from primary sources like COMEX reports, Silver Institute data, CFTC COT, SGE withdrawals. Do your own homework. Know your risk tolerance, and never follow anyone blindly, including me. All right, let's get into it. Drop those OGs and locations, and we'll move to the core dislocation that's driving this environment right now. The hook today is this glaring dislocation that's staring us in the face. Silver's physical premiums in key Asian markets, especially Shanghai, Dubai, and parts of USA, are running dramatically higher than Western paper benchmarks, even as COMEX futures have seen violent liquidations and margin hikes that wiped out leveraged positions in the West. Here's the abnormality in plain view. Just look at recent reports from physical dealers and market participants. In places like China and the Middle East, retail and wholesale premiums on physical silver bars and coins have exploded to $3.50 to $8 per ounce over spot, or even higher for smaller denominations, while COMEX spot and futures have been swinging wildly downward in paper-driven sell-offs. We're talking about physical silver trading at meaningful premiums in high-demand regions, with some suppliers halting new orders or rationing allocation entirely because available supply simply can't keep up. Why is this happening there, but not fully reflected here in the Western paper markets? Because the paper price COMEX futures, ETFs, derivatives has been dominated by margin calls, forced liquidations, and algorithmic unwinds following the extreme volatility spike at the end of January. Silver saw one of its most historic single-day plunges ever, down around 26 to 31% in sessions, triggering repeated margin increases from the exchange, up to 15% on some contracts. That kind of forced selling in thin liquidity environments decouples the paper quote from physical reality fast. Meanwhile, on the ground in Asia, structural industrial demand from solar, electronics, EVs, and defense continues unabated, cumulative supply deficits stretching years, with estimates of hundreds of millions of ounces drained since 2021. Retail and wholesale buyers aren't waiting for paper to stabilize. They're paying up for immediate delivery because shortages in physical products have worsened significantly. Geographic arbitrage is alive. Physical ounces in Shanghai or Dubai command far more than the COMEX benchmark suggests, creating a clear east-west split where physical metal is being pulled toward higher premium regions. This isn't just noise. It's a classic sign of paper pricing losing its grip on the underlying physical market. When futures crash on leverage unwind, but physical demand keeps premiums elevated and inventories continue to drain, COMEX-registered silver stocks have seen sharp withdrawals in recent periods, with ratios of open interest to deliverable supply pushing extreme levels. It signals stress in the system. The urgency here is real. These dislocations don't resolve quietly. They build until something gives. Either paper catches up to physical reality through higher spot, or we see further forced adjustments in futures that expose the leverage mismatch even more. This is the exact kind of divergence we track. Physical overwhelming paper, geographic splits widening, and inventory dynamics tightening under the surface. We'll dig deeper into the data sources next. COMEX reports, COT positioning, SGE trends, to show how this fits the bigger picture. But first, if you're seeing similar premium spikes where you are, drop your observations in the comments. Or if this east-west gap is new to you, let me know. We're building the map together. Stay calm, stay data-focused. No FOMO, no panic. This is system stress analysis, not a trading signal. Verify everything yourself. We'll continue in the next section when you're ready. Now let's move into the data-driven breakdown, sticking strictly to institutional-grade sources so you can verify every point yourself. We're focusing on the core mismatch. Physical demand signals overwhelming the paper pricing mechanism, inventory drain accelerating, geographic arbitrage widening, and liquidity risks building in the futures complex. First, COMEX inventories via CME Group warehouse reports. Latest figures as of early February 2026. Registered silver, the metal actually available for immediate delivery against futures, sits around 103 to 113 million ounces, down sharply from higher levels earlier in late 2025. Total inventory, registered plus eligible, hovers in the 403 to 411 million ounce range. The key stress metric here is the ratio of open interest to registered supply. Recent CFTC data shows futures open interest around 156,000 to 165,000 contracts, each 5,000 troy ounces, equating to roughly 780 to 825 million ounces of notional exposure. That means registered inventory covers only about 13 to 14% of outstanding paper claims. When delivery notices spike, as they did in January, with millions of ounces standing for physical, this coverage ratio gets tested hard. We've seen repeated withdrawals and conversions from registered to eligible, draining the immediately deliverable pool, even as total stocks decline modestly overall. Cross-reference that with CFTC commitment of traders, latest as of late January/early February 2026. Non-commercial, speculative, net long positions have fluctuated but remain elevated in aggregate, while commercials, often hedgers, show mixed but historically tight positioning. The report highlights persistent speculative involvement on the long side amid volatility, with open interest holding firm despite price swings, classic sign of leverage still in play rather than full unwind. Now shift east, Shanghai Gold Exchange, SGE, and broader Asian flows. While exact daily withdrawal numbers aren't always public in real time, market reports and dealer observations point to sustained physical offtake. Silver benchmark prices on SGE have shown premiums over Western spot, with deferred contracts and physical bars commanding meaningful uplifts. Industrial and retail demand in China, tied to electronics, solar, EVs, and grid infrastructure, remains structural, even if short-term economic pressures cause temporary dips. Geographic arbitrage is clear. Physical silver pulled toward Asia, where end users pay up, leaving Western paper markets to absorb leveraged liquidations without corresponding physical support. MCX India mirrors similar dynamics, futures prices reflecting local demand strength, with physical premiums in rupees holding firm relative to global benchmarks despite volatility. Retail and wholesale channels in India continue to absorb ounces amid cultural and investment buying, adding to the global drain. Silver Institute Supply-Demand Framework from the World Silver Survey 2025 and forward estimates. The market has run structural deficits for multiple years running. 2024 saw demand around 1.16 billion ounces against supply closer to 1 billion, with industrial use hitting records despite some thrifting. Projections into 2025 to 2026 show continued deficits, even if moderated by high prices encouraging substitution in spots, driven by green tech, solar PV loadings, though reduced intensity, AI, electronics, defense, and EVs. Mine production remains inelastic, can't ramp quickly, while recycling provides only partial offset. Cumulative deficits since 2021 have drained hundreds of millions of ounces from above-ground stocks, including Western vaults. Put it together. Physical demand industrial, plus investment, is overwhelming paper pricing. COMEX registered inventories drain under delivery pressure. Open interest to registered ratios scream mismatch. Asian markets pull metal at premiums, and multi-year deficits remove buffer. This isn't about one bad day. It's systemic stress where paper can decouple violently from physical until convergence forces adjustment, often upward, in spot when leverage unwinds, exhaust, or delivery defaults loom. No hype here, just the numbers, showing paper losing monopoly control over pricing discovery. Physical reality is asserting itself, geographically and structurally. We'll touch on the technical snapshot next to round out the picture, then tie it all into the macro thesis. If any of these data points, COMEX reports, CFTC COT, Silver Institute, SGE trends, prompt questions, or you want sources linked in comments, drop them. Always cross-check primary releases yourself. CME Daily Stocks, CFTC Weekly, etc. Quick technical snapshot, keeping this brief and surface level only, as always. This is not trading advice, not a signal to enter or exit positions, and definitely not the focus of what we do here. We mention these indicators simply to show technical competence and context around price action, especially after the extreme volatility we've seen. Starting with gold. Spot and nearby COMEX futures are hovering around the $4,900 to $4,950 per ounce zone as of early February 2026, after sharp drawdowns from recent highs followed by partial recoveries. On the daily chart, price has tested and bounced from key longer-term support areas near the 200-day moving average, currently in the mid-4600s to low 4700s, depending on the exact contract. Shorter-term moving averages, 50-day and 20-day, are still sloping downward post-selloff, creating potential resistance overhead if price pushes higher. RSI, 14 period, sits neutral around the 45-50 area, neither overbought nor deeply oversold, indicating the violent momentum has cooled, but no strong directional conviction yet. Ichimoku clouds show price below the cloud on shorter timeframes, bearish bias short term, while volume profile highlights heavy accumulation zones lower down that acted as support during the plunge. Silver has been far more volatile. Spot futures trading in the mid to high 70s, recent prints around $76 to $83, with wild intraday swings. The metal saw one of its steepest corrections ever, dropping over 30% in sessions before rebound attempts. Technicals reflect that chaos. RSI 14 dipping into the low 30s to upper 30s on recent lows, approaching oversold, now rebounding toward neutral 40s, suggesting exhaustion and selling, but not yet a confirmed reversal. Moving averages are compressed and bearish short term, price below 50-day and 20-day, with the 200-day still far above as long-term support resistance. Ichimoku shows price well below the cloud, signaling continued downward pressure until a decisive close above it. Volume spikes during the liquidation phase were massive, typical of forced unwinds rather than organic selling. Overall picture. Both metals are in a post-extreme volatility consolidation phase. Technicals show short-term bearish remnants from margin-driven sell-offs, but longer-term structures, like distance from key MAs and prior highs, remain intact in the uptrend context from 2025. No parabolic blow-off top confirmed. Instead, classic leverage purge followed by dip buying interest. This snapshot just confirms what the fundamentals are screaming. Paper markets can swing wildly on liquidity events, but the underlying physical stress doesn't vanish because of a bad week in futures. We'll now tie everything together into the macro reframe, the one core thesis that connects the dislocation, the data, and the technical noise. If any of these levels or indicators spark questions, for example, specific chart sources like TradingView, bar chart, or CME data, drop them in comments. We can point to primaries. Always pull your own charts and verify. No one-size-fits-all here.